Morning, Fiona.
Good morning, Amanda.
Thank you very much for joining me. What we wanted to do was give our clients and people who might be thinking about separation just some input about the financial climate at the moment. Lots of people who are separating do become understandably worried about financial matters because they're worried about their financial future. So I wondered if I could just ask you a few questions about your own experiences as a financial advisor. Are we currently in a recession, first of all?
We are, yes. So we have now moved into a recession. I think sort of the impact of COVID-19 and just that lockdown, the economy has massively contracted. And so we saw GDP fall sort of around about 2% in the first quarter. And then we actually saw an over 20% fall to the end of June. So we are now in a recession.
Lots of people will be worried about what that means in terms of financial provision. When it comes to valuations, how do you think that property market's stacking up at the moment?
Yeah, so with recession, you typically tend to see a sort of an increase in unemployment, economic spending drops, there's an uncertainty. We're really in the very early stages of this, but actually surprisingly, at the moment, we have seen property values have probably actually just increased. And there's a couple of reasons for that. There was pent-up demand, a lack of supply. We've got really low interest rates at the moment. So actually the cost of borrowing is low. And we also have this new scheme, the stamp duty holiday. So actually, early indications are that we're actually seeing an increase in property values, but it's early days. And as those unemployment figures come through, we may start to see sort of the property valuations fall.
Okay, so clients who are thinking about buying or selling, this might be a good time to think about doing that?
It's very, I don't think there's going to be a sort of a good or a bad time. It's very difficult. As I say, at the moment, it's very difficult. And I think it's going to come down very much. It's going to be property specific and location specific. We're seeing, for example, that some people are starting to possibly move out of towns. If they're able to work from home, they've got that flexibility. So actually out of town properties are probably seeing a lot more interest than they possibly might have done at the start of the year. But it may be a very narrow window, and there's just an awful lot of things that could change over the short term. But certainly I don't think it's all the doom and gloom that possibly people might have thought.
Okay. And another key area for people, pensions and investments. How do you think valuations of pensions and investments might be affected?
Yeah, so again, there's been quite a change across the different types of assets and investments. So probably actually if we talk about investments first, because they will then tie into pensions. Within the investment portfolios, it will come down very much to the spread of investments. So sort of bonds, you shouldn't have seen such dramatic changes in the valuations there. However, investments of equities, the stock market, it really comes down to where you're invested. So everything fell very sharply in March. We saw the UK market fall, we saw European, Asian markets, the US, but actually they've all recovered at different rates. So for example, the US market is now nearly at all-time highs, whereas the UK market, measured by the FTSE 100, those largest 100 companies in the UK, probably still around about 18% off where they were at the start of the year. And there's a couple of reasons for that. The UK market is very sort of heavily weighted to the oil companies. So obviously there's been sort of a fall off there. There's also banking within the UK company and very low exposure to technology, whereas actually across in the US, they've got much larger exposure to the companies such as things like Zoom and Amazon, companies that have really benefited from the lockdown, and that has pushed that market up. But then there's other parts of sort of within sort of the investment portfolio and commercial property. Now we've talked about sort of housing, the house. But actually retail property has struggled a bit because we've just seen the high street really close, and and that has been a very sad sort of outcome that we're starting to see come through of this pandemic. And commercial property, retail property is very much valued on rental income. So taking that into pensions, with pensions, there's different types of pensions, so it really depends on the type of pension. So if you've got a final salary pension scheme, those benefits should still be paid. But if you're looking at actually valuing those final salary pensions, there can be some quite large changes in actually the value of those pensions. So you would be looking, I suppose, for the cash equivalent transfer value. And those values could have shifted really quite dramatically over the period, both up and down. If somebody has a defined contribution pension, so that is just typically a personal pension or a SIP, it will be very, very much down to what the makeup of that is. So if it's heavily weighted to the UK, you could still have seen that value could have dropped, as I say, sort of 18% or more. If it's more sort of weighted towards the US, actually, it could be at a higher level. So it comes very, very much down to the individual investments and pension.
So I suppose the significance for us as family lawyers is that valuation becomes really quite critical, and we might need to start thinking about resources arguments, maybe a bit more creative thinking around valuations and future planning. How do you think input from a financial planner could assist during the separation process?
Yeah, well, you probably won't be surprised that I'm going to say I think it's really, really sort of critical, particularly at the moment, because there is this wide variance in how things have moved in value over the period. A financial planner can look at the assets. They can see the sort of the tax benefits of each of those assets. They can look at the liquidity of each of those assets. So, an investment portfolio can be typically liquidated quite quickly, as opposed to a property, depending on where it is, may take longer. But they can also just look at the broad range to make sure that you're not taking on any sort of unnecessary risk, that everyone's understanding the assets within those portfolios. So, I definitely think getting financial input is critical. And, I think something possibly that we would always recommend and would be something cash flow modelling. With that, you're basically looking at taking those assets and trying to just provide a picture of what the future might look like. And we find that can actually provide a real comfort for people, because actually it's a really, really sort of uncertain time. And so just being able to actually look at to see how your income flows may look going forward, depending on different scenarios, we can map those out, I think is extremely, extremely helpful.
One of the most helpful questions I think family lawyers can ask at the outset of an instruction is just, what would you like your future to look like? It's good to be future focused and just have some reassurance around what the future can hold in a positive way. So it's really helpful to know that's something that financial planners would focus on too.
Yeah, I think so. I think, I've seen it firsthand just how much sort of comfort it can provide to an individual. So I would definitely recommend getting a financial planner involved, and probably getting them involved at quite an early stage.
Okay. That's been really, really helpful. Thank you very much.
Oh, it's been lovely, lovely talking to you, and delighted to do this.
Thank you.
Thank you.